In this video, we'll take a closer look at 5 essential candlestick patterns and learn how to spot them on your charts. Now, before we get into the different candlestick patterns, we first need to understand, what are candlesticks? Candlesticks are the simplest and most effective ways to visualize how price moves over time. Each candlestick represents how an asset's price moved during a specific time frame. For example, on the daily time frame, a single candle shows 1 day of price action, and on the hourly time frame, a single candle shows 1 hour of price action. A lot of beginners prefer to use the line chart because it's simpler. However, if you want to navigate the markets like a pro, you have to use candlestick charts, because candlestick charts give significantly more information about the market compared to a line chart. A line chart only shows 1 data point, the closing price, while candlestick charts show 4 key data points: opening price, highest price, lowest price, and closing price. This gives us a much clearer picture of how price moved within a single time frame. How to read a candlestick. Reading a candlestick is quite simple to do. First, we have green candles and red candles. A green candle forms when the closing price is higher than the opening price, meaning buyers pushed the price upward during that period and were stronger than the sellers. A red candle forms when the closing price is lower than the opening price, meaning sellers pushed the price downward during that period and were stronger than the buyers. Now, to understand how a single candlestick takes shape, here's how price moves during that period. The candle begins at the open. When the price drops, it creates a low. Then when it moves up, it creates the high. And where the period ends becomes the close. These 4 points combine to form the candlestick you see on the chart. So now that we understand how to read a candlestick, let's break down the different candlestick structures that can form on a chart. And make sure you pay close attention to this, because this is essential for understanding the patterns later on. Candlestick structure 1. Big versus small bodies. The body of a candlestick can tell you the strength or weakness of buyers and sellers. Take 2 green candles as an example. In the first candle, the body is large with small wicks. Price opened lower. Sellers tried to push it down, but buyers quickly took control and moved the price up with almost no resistance. The candle closed near the high. This shows that the buyer strength was clearly much stronger than the sellers. Now compare that to the second candle, which has a small body and long wicks. Price opened. Buyers did push the price up at first, but sellers stepped in with strength and forced the price back down. The candle still closed slightly above the open. This shows that while buyers were still stronger, the difference in strength was minimal. Candlestick structure 2. Long wicks. The wicks of a candle can tell us whether there was strong rejection from one side. A candle with a long upper wick shows that at one point, price was pushed higher. However, before the candle managed to close, sellers stepped in aggressively and rejected those levels. This means that there was strong selling pressure at the top. Similarly, a candle with a long lower wick shows that at one point, price was pushed lower. However, before the candle managed to close, buyers stepped in aggressively and rejected those levels. This means there was strong buying pressure from the bottom. So depending on where the long wicks were placed, that's where you can tell which side is applying pressure and the likely direction price may move next. Now that we understand the different candlestick structures and what they represent, we can move on to the 5 key candlestick patterns every beginner trader should know. Pattern 1. The engulfing. An engulfing pattern is a 2 candlestick pattern. It starts with a smaller first candle, followed by a larger candle of the opposite color. The key requirement is that the body of the second candle completely covers the body of the first candle. The engulfing pattern consists of 2 types: the bullish engulfing pattern and the bearish engulfing pattern. In the bullish engulfing pattern, the smaller first candle is red and the larger second candle is green. The key point is that the body of the green candle fully engulfs the body of the red candle. In the bearish engulfing pattern, the smaller first candle is green and the larger second candle is red. The key point is that the body of the red candle fully engulfs the body of the green candle. An example would be, if the price is in a downtrend and a bullish engulfing pattern forms, it may signal an upward reversal. This happens because the pattern shows buyers gaining strength, as seen in the large green candle pushing the price higher than the previous small red candle. The bigger the second candle, the stronger the reversal signal. If you spot a bullish engulfing pattern, you can enter a buy position at the close of the large green candle with your stop loss placed at the bottom wick of that green candle. The same logic applies to bearish engulfing patterns. If a price is in an uptrend and a bearish engulfing pattern forms, it may signal a potential downward reversal. This happens because the pattern shows sellers gaining strength, as seen in the large red candle pushing the price lower than the previous small green candle. The bigger the second candle, the stronger the bearish reversal signal. If you spot a valid bearish engulfing pattern, you can enter a sell position at the candle's close, with your stop loss placed at the top wick of the red candle. Pattern 2. The pin bar. A pin bar is a single candle candlestick pattern made of a small body and a long wick on one side. There are two types of pin bars. A bullish pin bar, which is a green candle with a long wick at the bottom. A bearish pin bar, which is a red candle with a long wick at the top. When a bullish pin bar forms on the chart, it means sellers initially pushed the price down, but buyers stepped in, strongly rejected that move, and pushed the price back up before the candle closed. This shows that although both sides were active, buyers ultimately took control. A common trade setup is to place a buy order above the pin bar's high with a stop loss below its low. The same logic applies to bearish pin bars. When a bearish pin bar forms on the chart, it means buyers initially pushed the price up, but sellers stepped in, strongly rejected that move, and forced the price back down before the candle closed. This again shows that although both sides were active, this time sellers ultimately took control. A common trade setup is to place a sell order below the pin bar's low with a stop loss above its high. Pattern 3. The doji. A doji is classified as having a small body with equal wicks on both sides. When this pattern forms on a chart, it shows that neither buyers nor sellers are in full control. Therefore, the market is in a state of indecision. When a doji forms on an uptrend, it signals that buying pressure is weakening, since buyers are no longer able to push the price higher. Similarly, when a doji forms during a downtrend, it signals that selling pressure is weakening, since sellers are no longer able to push the price lower. A common trade setup for the doji pattern is to enter when a large-bodied candle forms after it, as it acts as a confirmation that the trend is changing, with the stop loss placed just below the low of the doji candle. Pattern 4. The evening star pattern. The evening star is a 3-candle pattern. The first candle is a large, full-bodied green candle. The second candle is a small-bodied candle of any color. The third candle is a large, full-bodied red candle. The evening star is a bearish reversal pattern. It typically appears in an uptrend, and it often signals that the price is ready to turn downward. This is because the evening star shows the shift from strong buying to complete loss of momentum, and finally to sellers taking control. The green candle shows aggressive buying. The second candle shows buyers slowing down and losing strength. The third red candle confirms that sellers have stepped in, pushing the price down and reversing the trend. A common trade setup is to enter a sell trade below the red candle's low and place a stop loss above the high of the second candle. Pattern 5. The morning star pattern. The morning star is a 3-candle pattern. The first candle is a large, full-bodied red candle. The second candle is a small-bodied candle of any color. The third candle is a large, full-bodied green candle. The morning star is a bullish reversal pattern. It typically appears in a downtrend, and it often signals that the price is ready to turn upward. This is because the morning star shows the shift from strong selling to a complete loss of momentum, and finally to buyers taking control. The first red candle shows aggressive selling. The second candle shows sellers slowing down and losing strength. The third green candle confirms that buyers have stepped in, pushing the price up and reversing the trend. A common trade setup is to enter a buy trade above the green candle's high and place a stop loss below the low of the second candle. Now that you've learned these 5 essential candlestick patterns, you can start applying them in your trades. If you found this helpful, make sure to like and subscribe to the Capital.com YouTube channel so you don't miss future tutorials. Thanks for watching.